Thank you very much for inviting me to discuss this paper. Actually, the first time I saw this type of models was a presentation by Pablo of the paper with Dean that's now in Econometrica. And I really want to extol the importance of this model, because basically what Dean and Pablo have done is they have consolidated the literature in the banking industry and transformed all these elements that were scattered around theoretical models and empirical models, and come up with a quantitative framework, which has lots of applications that would help the policy setting, answer many questions. For example, they have already answered, for example, what would be the effects of Basel III capital regulations, the Rigel-Neal Act, in the paper that has presented now, and the stability competition trade-off. So having said this, the present paper is trying to approach what are the effects of geographic diversification in the bank lending channel of monetary policy, and vice versa, probably. And what we really know now is that bank distribution matters. We know Kashyap and Stein that the behavior of smaller banks is different from the large banks. And this is going to change during the cycle along risk-taking, and also could be some small changes around market structure during the cycle. So the question is, what happens when the banks are allowed to expand across regions? To make the discussion a bit shorter so you can ask your questions, I'm going to skip the overview of the model, and I'm going to comment on the main results by Dean. Actually, I found it quite puzzling. I know he's in the process of trying to explain why this is the result for now. But I was thinking, okay, why does this happen, even though there are much larger banks now? I mean, that would make the banks less sensitive to monetary policy. But I started reading Corbet and Levine paper of 2018, and in there it is shown that competition increases sensitivity to monetary policy. So that begets the question, does diversification induce greater competition inside states, at least in the short term? Because some banks might enter the other states, and that's going to increase competition in our North environment, to my knowledge. And the other question is, maybe that short-term effects might be different than long-term effects. For that, probably they would have to analyze the transition between two interest rates. The other question is that, could it be as asymmetrical as well? Sorry for the typos. I'm thinking that, for example, during expansion, one may have a higher interest rate margin, so that it's going to increase bank entry, probably increase competition and increase sensitivity. And on the other hand, contraction may lead to bank exit, lower the competition, and reduce sensitivity. I think this was a discussion that was held during the last global financial crisis. Just giving my thoughts here, because I was really disconcerted by the results. And the only technical comment I'm going to make on this paper is the way the monetary policy contraction is modeled. Because basically, I think you are increasing only the interest rate when you have external funding liabilities, but not for all the values of A. So I don't know if that might make a difference. Something to bear in mind, probably, for the calibration. And a topic that I didn't put in the slides, but actually I came up with those thoughts now, is that perhaps there could be, I'm guessing, is it possible to separate the effects, for example, keeping parameterization constant, and then see what happens with geographical diversification, and then go the other step, changing the parameterization, and maybe that's going to help clarifying the results. But I'm really looking forward to see the results on monetary policy, and even more so, given that you are thinking about this decision of banks are going into other states, why not thinking about going into other countries and say what are the implications for for domestic monetary policy or international macroeconomic policy implications, and not only macroeconomic policy, even financial policy across borders. So I'm going to end up here and leave the floor open for some questions if there is time.
So we're going to do it that time, but I think we may have time to get one or two questions from the audience because you raised a lot of interesting issues on international organization, competition, and I know there's a lot of people here interested in those issues. Please go ahead.
Hey, I thought this was a super fascinating paper. So I have kind of three questions. So one is it the case that financial cycles have become less correlated regionally over time now that the banks no longer have to lend out of local deposits? Is it kind of a fact, something that you observe in the data, which I think is an implication of the model? A question I have more like thoughts that you have. This is an industry equilibrium model. So if you were to go to a general equilibrium model, thinking about implications for monetary policy, say, what you see is the big challenges that you face, and in particular, it sounded like the deposit demand here was exogenous, and so how would you think about making this endogenous? And then a final thing on MPL, I think that's kind of a great way of framing the economics of the model, and maybe super useful for interpretation. There is a paper by Johannes Strobel and some co-authors in the QJE that have used this idea too. It's the marginal propensity to lend to different types of borrowers, and they estimate that or measure that, and then they see how that correlates with the marginal propensity to borrow from these borrowers. So are they actually willing to how well it correlated is the MPL and the MPB, which is a paper you might be interested in.
Do you want to go with comments from David? Please go ahead, Marco.
I know I have one of the same questions as Adrienne, which is like there is this literature right by Strobel and co-authors emphasizing competition for deposits. But in your model, deposits are exogenous. Is there a reason why you think that's not important? Is it too complicated? Why these models don't have that? Thank you.
Should I go?
Please go ahead.
Okay. First, thanks so much. I kept on sending him, like last night I was probably sending him the paper and stuff. Not at 3 o'clock in the morning though. I think one of the things that I didn't have enough time to do is thinking a lot about the decompositions that would be good to do, because there were multiple things. Everything that were in the different tables, we fed into the model. So in kind of contrasting pre-Regal Neal to post, there's really a lot of decompositions that should be done, but that would have been done at 3 o'clock in the morning, and we didn't get them done. The idea of, this is just a general framework of kind of thinking about what a region is. So, things can be applied to cross countries and stuff like that. We have something in the IMF economic review about thinking about stuff across countries. It's a very different model than this, but you can do that. On the financial cycles, Adrienne, I don't know that per se. Let me say a few things about data that comes from the Jackson Hole conference. So Ross is a great empirical guy. So we applied, and this actually goes to Marco's question to some degree. There's two different. We decided, as a macroeconomist, thinking about the crisis in 2008. I was focused on bank lending. What is going to be the impact on bank lending of the crisis? And so when we were looking at data, we were kind of thinking the loan market doesn't appear to be perfectly competitive. That's why we put the imperfect competition in the loan market. The paper with Ross for Jackson Hole was we had the imperfect competition on the deposit side. So you can do both, and actually Tony Whitehead has a paper where they do both sides. So that's, we wanted to keep focusing. It's a lot simpler paper in many ways than what we're doing, so we wanted to incorporate things that's not in theirs. But I love the idea of doing these MPLs at the borrower level. This is what Andres is. So call report data does not have enough degree of loan borrower level loan statistics, and University of Wisconsin is too cheap to buy that kind of stuff. That was a joke. I don't want anyone. Don't say to any of my colleagues that we. But yeah, we don't have that same kind of data, so we can't do that. But we could obviously, it would be useful. We could somehow maybe aggregate their stuff up to MPLs. That's a great. I need to find that paper. One thing I didn't show you, given that we have endogenous exit, the model is supposed to be, kind of taking into account what are the costs of different policies. So, we have endogenous bank exit here, but there is FDIC, there's a deposit insurance. So you can actually kind of use the model to say, what are the implications for, what taxes have to be paid associated with bank failure relative to different types of policies, regulatory policies and monetary policies. The last thing about, this was kind of thinking a little bit about the monetary transmission mechanism, but the very simple way to think about some of this stuff, that's associated with that Jackson Hole paper, is that if you have very small profit margins at the bank level, and you have this moral hazard problem, they're going to start reaching for yield the more competition there is, and so so you can actually there's a big literature on competition versus stability. It's typically an international literature. So people tend to regress things like failures and stuff like that on concentration across countries. And the results are, because you don't have a lot of, in some sense, good data on that, the results are kind of inconclusive which way it goes. The thing that Ross did that was, I thought, ingenious was he constructed pre-Regal Neal. I kind of said this a little bit. The certain states before 1994, when it became national, that you could branch, certain states opened up before that. So then he was able to kind of take data and say, I'm going to have state and time level variation. But the ingenious thing he did was also kind of take he used a gravity model from international trade to say how far away is the bank that is going into the next state, how far away were they? And so that generated both time, state, and bank level variation that generated enough data variation to kind of think about this competition stability stuff very carefully. And so when in that Jackson Hole paper, we kind of regressed, measures of bank stability, like the variance of stock returns and things like that, both on, even on things like monetary policy shocks, Fed fund shocks. And because if Fed fund shocks start dampening profitability of banks, then it raises it does lead to more instability. So it's just something to kind of think a little bit about in terms of how regulation and how monetary policy acts through market structures. So and I'm out of time.